Hello everyone, welcome to another episode of Money Monastery. So if you earn, if you save and if you invest, you must have heard a word mutual funds. But do you really know what are the mutual funds? How does it work? What are the things that we should analyze? What are the different types of mutual funds out there? Because without knowing all of this and investing blindly, do two things. First, it is not giving you the right returns that you deserve, and second, it is keeping you far from achieving your financial nirvana. So make sure you understand mutual funds completely. And today, in just a matter of 9 minutes, we'll be unfolding what are the different kinds of mutual funds, how to analyze the mutual funds in a very layman language so that it serves a greater purpose of you evaluating the mutual funds you are invested in already or you are looking to invest in. So let's dive in. Starting with, so there are broadly, if we talk about, there are four types of mutual funds. The very first one is equity based, which directly invests in companies registered on the stock market like Reliance, Tata Motors, Eicher, and big companies like that. And then we have different debt mutual funds which invest in government bonds or the bonds released by the banks. So this is a relatively less risky asset and gives less return as compared to the equity mutual funds, which are relatively high risk and high reward as well. And then there is a combination of these two, which we call the hybrid funds, where there is some component of mutual fund invested from equity side also, and some part of mutual fund invested in the debt side. So these funds are called hybrid funds. And then there is a category, index funds. It is an equity kind of fund, but it just mimics the returns that is generated from the indexes like Nifty 50 or any metal index or IT index. So it just mimics the behavior or gives you the same return as that index returns. So it is from the purpose, like if you invest in Nifty 50 companies, then you can get an index fund and you will get a return on your portfolio equivalent to the returns that you would have gotten if you invested in Nifty 50 stocks. So these are the four broad categories, and we will be deep diving in the equity mutual funds because that's where the most of the money of you will be invested. In terms of types of equity mutual funds, the first one is large cap. So large cap by the name means all the big companies. If there are just blue chip companies like Reliance, Tata, Birla, all these companies are there in the mutual fund portfolio of the mutual fund manager. These are the companies, then it is called large cap. And same goes for mid cap and small cap category as well. So large cap comprises of large companies, mid cap companies, small cap companies. And then in terms of risk level, as you see, it is low to high. Small cap is highest return, but it is very good for aggressive investors because it holds a very good upside. Because if a company is small right now, it might become big in future, and hence the chances of growth, the multiplier of growth is huge in the small cap companies as compared to large cap companies. And then there is a flexi multi cap, which is a combination of large, mid, and small cap. Personally, flexi and multi cap is something that I prefer the most so that your risk is diversified and the returns are better. And this is personally my favorite one. And then there is the other category, dividend yield. This is if a portfolio of the mutual fund is very dividend specific or focused on dividend giving stocks, then it is a high dividend yield mutual fund category. And then there is ELSS. ELSS is something where you invest in a mutual fund and the returns from that are tax free. And but the catch here is you have to keep your money locked in for 3 years. So this is a good investment asset class if you want to get some tax relaxations under Section 80C as well. Then the second last one would be sector thematic. So if I'm bullish about a particular sector, let's say automobiles or artificial intelligence, so I can identify a mutual fund that operates under that sector or within that theme, and it will give me a good understanding, or it will give me good exposure to most of the stocks, good stocks out there in that particular sector. So if you want to invest in a sector or thematic mutual fund would be the right choice. Then the international funds would be if you want to increase your exposure globally, if you want to get exposed to the China economy or the US economy, then there are some options in Indian markets which give you exposure to the international mutual funds as well. You can take a screenshot of this probably and save it for later so that you can make a more informed decision in terms of your risk appetite and the focus of a particular mutual fund, which makes more sense for you. Now, we will dive into a very important aspect, that is how to assess what to see while buying a mutual fund, or if you already hold one, then what all to see to understand if I am into the right mutual fund or not. The very first one, and this is, I've taken SBI mutual fund as an example from the website of Grow. You can check it for any mutual fund on any of the websites out there, probably Coin or Grow or Upstocks, wherever you would like to. So you should first check the rank. So SBI mutual fund ranks 1 in terms of total assets, and the total AUM is around 1063207 CR, which is huge. So good AUM, the asset under management, and the rank is crucial to understand like it is a decent one out there, and it is not just managing a very small amount of money, and the rank of total asset is also decent. Personally, I prefer mutual funds under rank 50. Then we see date of incorporation. It is since 29 June 1987. So it's a pretty old one and it's a reliable one. I'm not saying that don't invest in the new mutual funds, but the more the time the mutual fund is out there in the market, the more is the chances that it has provided good returns to investor. That's why it has lasted for this long and we are seeing it in the market still. Then definitely check out who is the fund manager, because that person is managing your wealth. So that person needs to be well educated with a decent background. So check your fund manager. So here if we see, if the fund manager is Saurabh Pant and he has done BCom, MBE, CFA level 3, and he has been associated with SBI Mutual Fund since 2007. So all these are good green flags because of the fact that his education is good, making him a reliable person or making him a trustworthy person for management of the assets. And then he has been associated for the last like 30 odd years with SBI Mutual Funds. So he has a good track record as well by staying in the same company for long. So look for the credibility of the fund manager, look for his track record before investing in a mutual fund. Then the next parameter would be returns and ranking. This is something that we usually check, but check it not just at an absolute level. Check it with the category. So if you see 1 year and 3 year and 5 year returns, here it beats the category average across all the three verticals, 1 year, 3 year or 5 years. So that should be the ideal case. Your fund, the fund that you are interested in, the fund you are investing in, should beat the category average and should hold a good ranking within that category. Again, as a rule of thumb, make sure that you're not going below 20, 25 in terms of rank within the same category. Now, expense ratio and exit load. What is expense ratio? So expense ratio is amount of money that the mutual fund manager will keep from your returns as an admin or operation cost, because he's managing it actively, buying and selling, doing research on your behalf. So there is a portion of money that they keep as a operational cost, and that is called expense ratio. So the lesser the expense ratio, the better it is. So something around 1.5 or less is considered good, and you will be aiming like ideally under 1, but less than 1.5 looks good. So here it is 0.76, which is pretty reasonable. And then the exit load is just 0.1%. So exit load is something that the money that is charged if you exit early. So you need to make sure that it is negligible or on a very low side. So a lower expense ratio and a lower exit load is something that we're looking for. And here if you see, both of them are green flags for this particular mutual fund, and you can check it for yours or the ones that you're interested in. Now next one would be, so if it is a equity one or it is a debt one, you need to understand just equity and debt is not enough. What in equity, which sectors in equity, where in debt. So if you see that within that particular mutual fund, there are some sectors involved for which you are not very familiar with, you're not very convenient investing in those sectors, or the exposure to that sector is pretty huge, then you can make a conservative call and choose not to invest in that mutual fund because you are not very bullish, you are not very optimistic about that sector. It might turn out to be that I am not very optimistic about the metals and mining sector, but the exposure here is 6.2%. So it is pretty reasonable. But let's say if the exposure would have been 30% in metal and mining sector, then I would have been hesitant because I'm not bullish, I'm not confident about this sector. So analyzing the sectors within a mutual fund becomes very crucial. Now, if you see, these are some advanced ratios just to give you a directional sense. A PE ratio of 24. This is almost on a high side. It's a bullish market, so everything is little overpriced already. So you need to make sure that the PE ratio is pretty reasonable, and at max should not cross 30 or 40, because it's a price to earning ratio, and you need to make sure that the price is not much as compared to earnings, and that you can assure by ensuring that the PE ratio remains for that mutual fund below 30 or 40. Now coming to alpha and beta. So alpha shows how much excess returns that mutual fund is generating over the index, and beta shows how much is the volatility of that particular mutual fund over the index. So if you see here, ideally alpha should be greater than 1. That means that it is giving more returns, it is giving you higher returns as compared to index. But preferably or ideally we should be chasing beta that is less than 1, and if you see here, it is less than 1, in this case 0.86, which is a good sign. So I hope you liked the video and you understood what are mutual funds. So next time you get into a mutual fund, don't just invest blindly, but check these parameters, assess these parameters, so that you're making an informed decision and you are making every penny you have invested earn more money for you. So hit the like button if you like the video, and join our Money Monastery community. So we want to just help you attain financial nirvana sooner than later.